or 2 hours, right? So if you're given in a 3-hour window, let's just take a 3-hour window, for instance. If you're given that, I would do like a bare bones LBO, right? Get to assumptions, valuation, sources and uses, and just a cash flow model that gets you to returns, right? So that, once if you have a set of financials that hopefully will take you 45 minutes to an hour, right? To just kind of go through that, check it, whatever. You don't need to build in cases, you don't need to do anything else. And if you're given a sim, I think I would just kind of flip through it and pick out like all of these things, but as quickly as you can, right? So understand the company, understand the industry. I mean, similar framework, you're just gonna have to condense your time. You're not gonna get growth rates, right? So there's no way you can go and predict growth rates. Maybe the sim will say that, but unlikely. So a lot of it's gonna be around, hey, this is my understanding of the company based on the management's projections. This is what I think that the returns are gonna be. However, I like the industry for X, Y, and Z reasons. This is what's the favorable things going on. Seems like they're capturing market share. This is where the growth is. But I really need to diligence all these other areas. But you still need to come up with the recommendation. Say, hey, based on the initial analysis, good company, good track record, good growth, good financials, risk around, market and competition and industry. But with these initial set of financials, we're getting to about a 20 to 25% IRR. So I want to do more work in this, and this is where I do the work. So that's probably how I'd structure your case study if you're given it kind of 3 hours to do that. Is that helpful?
Yeah, that's
amazing. Okay, cool. Any questions? Any other questions on this? Okay, so I think I want to go now to sort of a more detailed LBO, but before I do that, I do want to spend a minute. Now we're going to shift gears again to what is the day-to-day of a principal, VP, or senior associate here. So anyone who's coming from those backgrounds, like feel free, folks, to sort of contribute to this piece. So there's largely 4 buckets of work that you'll be working on. So the reason why I'm going to cover this now is because it's going to sort of make sense why we're testing you on all of these things, because it's what you'll be doing every day on the job, right? So the first bucket is raising capital or fundraising. What that means, it depends on what stage of firm you're going to and if they're in the capital raising. Typically, investment professionals are not involved. Most firms have like a business development fundraising arm that takes care of raising new capital. But where investment professionals are involved is if you're going out to raise more money from an LP, they want to know how your investments have done. So you need to help them understand, hey, this investment that we've invested in has been growing like this. This is the initial rate, because for LPs, like past performance is going to define a lot of if they're going to invest with you going forward or not. So what that means for you all is you're going to just create a few slides that say, hey, this is the company, blah, blah, blah. But you're not really going to be as much involved in the fundraising unless you go to a smaller fund, a middle market fund, where sort of there isn't, a lot of people there to help with that. So you may get staff to sort of work on the fundraising stuff. Again, it's just one component of the deal. It's not like it's bad or it's better or good or whatever. It's just one component of the job. Where you'll be spending a lot of time is this next 2 segments. So thesis generation, idea generation, and transaction execution. So thesis, idea generation there's a few ways we do this. One is I ask our associates or VPs to spend X hours a week really understanding a market, a segment, a sub-segment of the space, and coming up with trends and ideas and potential investment opportunities. This is called proprietary research, right? So you are either doing it behind a desktop or you're going and talking to people in the industry about this. But if you're covering the beauty space, for instance, you would say, hey, all right, or whatever, the consumer side of this, say, all right, what are the 4 or 5 segments of the space? Let's try to understand this in this space. And let's try to find the 5 or 10 companies that are doing it well, whether they're PE owned or not owned, and then let's develop a thesis around that space. So a lot of PE firms require our associates or VPs to spend 30% of their time developing white papers, theses on certain industries, because when deals do happen, we need to be ready to be operating in those, because we have 6 weeks to due diligence or something. So we're not going to be able to get and also we like our people to be somewhat specialized so that we can really be industry leaders. Because look, at the end of the day, deals get really done. Yes, we have capital, but what else do I bring to the table, right? Is it relationships? Is it my knowledge of the space? The management team isn't going to take your money, especially today when everyone has money, everyone has capital. Like, they want to know how you're going to actually help them in the industry. So the more you can establish yourself as sort of an industry expert, the better off you are in doing the deal. And everything I'm going to talk about here is a long-term view on your job, right? It's not like, oh, get a deal done. I want you all to be exceptional private equity professionals and advance and accelerate in the career, not just be great associates or VPs, right? So how do you become an exceptional principal or an MD is actually developing great areas of expertise that you can be the sort of the sector expert on. The other way I do this was the most challenging part of my job when I was kind of going through the ranks, is developing relationships, right? So predominance of your deal flow is going to come from your relationships with the market, which is either management teams or with investment bankers or consultants or other advisors, right? So you have to sort of always be in the know, because you can't just sit in front of a computer and do all this proprietary research and expect to be on deals or have any sort of shot at winning them, right? So you need to have a deal flow. You need to have a flow into investment bankers. So all of your banker friends here, you should be very friendly with as you go through this, but also sort of establish credibility in that space that you are a legitimate investor. So I actually ask our junior people to go meet 4 or 5 management teams every couple of weeks, right? So it's just a way so that they know who we are and they know sort of what we're working on. So does that make sense on thesis? And the VC growth level, I know some of you all are coming from that or interested in that. A lot more of your work will be on thesis generation, right? Just because you need to know a sector before you can take an early stage investment, into that sector. So I would say that is maybe 50 to 70% of your day-to-day is in thesis generation or sort of idea generation. Then transaction execution. So for the people going into private equity, middle market private equity, and so on, 70% of your day-to-day is going to be around transaction execution when you're going through a transaction. What does that mean? You are it says associate, but sort of senior associate VP is to execute on the day-to-day responsibilities, all the stuff we just talked about, right? So you're owning the company research, the building the operating model, the analyzing the investment returns, right? Conducting market diligence, due diligence, legal diligence, all of that stuff. The biggest area of transition for my people is they come in from banking or something where they're just doing the model, or consulting where they're just doing the operating stuff. And now they're being asked to deal with or lead end to end the entire diligence of the process. So everything that could go wrong probably will go wrong, but you're responsible for kind of making it right? So we found this random, contingent liability from a lawsuit back in 2019. Guess what? If you're an owner of that company, you got to resolve that, right? If you're a banker, you could be like, it's the lawyer's job. I don't really care. But I think if you're an owner, it's your job, right? So every little thing, hey, management team may not carry on with us. That's a problem, right? Because we need to get that sorted out, or there's sort of this, debt issue that it's going to pay us a lot of money to terminate this type of debt. That's an issue, right? If you're a consultant, you're like, don't care about debt. That's the banker's job. Or if I'm a banker, like, don't care about that contingent liability. That's the lawyer's job. But in private equity, that's your job, right? So you could hire a consultant, or you can hire a lawyer, or you can hire a banker, but it ultimately kind of buck stops with you, right? So that's the owner mindset that I need you all to communicate in your interviews, right? When you go into a case or a company, I own this company, right? I am going to invest in this company as an owner, and I can do that. Especially the people that are making the transition from banking or consulting. Can you go from an advisor to an owner? And that's where I will really sort of push you guys on. And then finally, you have the portfolio company management. Every company is different. Again, if you're going on the ops side, Andrea and some of the folks here, that's going to be the bulk of your role. So you're going to be working with us on value creation, which means post-deal. But even as an investment professional, you're again in charge of the investment. I mean, like board meetings are a good example. A lot of you might go become board observers or something, but you're working the entire, like board meetings happen every 3 months, right? So you really only have 16 to 20 checkpoints with the board. That's not that many, like in the ownership period. So our VPs and associates are always talking to CFOs and like almost on a daily basis, understanding what's going on, where can we help, can we identify issues well before they're sort of come to the board, right? So if we're hearing it at the board meeting for the first time, it's too late, right? So we want our associates and VPs to really build that capability of being able to manage the job. Again, that's a lot of, like, you're wearing all these different hats. And so I think it's important to contextualize for you guys what you're going into. So any questions on this side? Yes, what's your name?
Ravi.
Ravi? Oh, cool. All right. Hey, what's up?
I just wanted to understand for traditional PE shops where they do not have like they outsource their managing portfolio work, how much time would an investor spend on?
When you say outsource, do you mean to who? To like
to professional consultancy services who will just basically run the firm for them?
Okay.
That's not too frequent in this geography.
Yeah, that's quite infrequent. And I think, look, there's always nuances here. typically how it works is we try to outsourcing the running of a fund to a consulting firm is very, very expensive, right? Because it's sort of they're also working on other things. So what we try to do is a core part about our job is to put a management team in place that actually allows them to run the day to day. So yeah, I mean, you're not sitting here running the company for them, but you're there to sort of prioritize with the CFO or CEO of like what are all the things that need to get done, and then make sure you go in and actually that is actually happening, and you have the enough people and resources in place to do that, right? Because you as an owner or an investor, you have a set of things in mind that you obviously bought that company with certain expectations and certain things. So in addition to the business going as normal, hey, we want to grow into this market. How's that going? Want to do organic acquisition? How's that going? So you're more supporting the management team. Oftentimes you don't outsource the entire function, but you might hire a consulting company, right, to come on after the deal, at least the first 50 days, 100 days, and get sort of things in motion. Or you may have them do specific projects for you along maybe pricing or strategy or risk or operations. But typically, you don't necessarily outsource the whole function, if that makes sense. And then that's where sort of our in-house consulting or outside consulting comes in. So like if we have an operating value creation arm, they will be really involved in the deal as well, so that we don't have to be. At the end of the day though, the investment professional really needs to know what's going on at the level, to whether you're outsourcing it or keeping it in source, which is why people is really, really hard. So we got to convince great management teams to want to work with us at the company level, right? So that's another huge part of the job itself. Yeah, go ahead.
Just one follow-up. So, like in that model, you would spend almost as much time managing the portfolio as you would spend creating a white paper or a thesis for the industry, or more or less.
Yeah, so it's just a different part of the job, right? So I think those two are kind of different. So this, if I'm understanding your question correctly, this part of the job is like maybe you spend 15% of your day doing. It's not like you're doing that for 15 days in a row, right? You're every day you are talking to portfolio companies and seeing how they're doing. Similarly, like if there's no deal, sort of it's not that active, you might be doing a lot of white paper generation and thesis generation. But if a deal is really active, you may not be doing a lot of that. But this is something you should be doing ideally every single, like at least 2-3 times a week with every company that you're invested in, right? That makes sense. Cool. Any other questions on this? Yeah.
Out of experience, because you've worked in the industry before, when was the time that you had a portfolio company that wasn't performing as you expected, and what did you?
Yeah, it's a good question. So look, I think that is sort of the least optimal positions to be in, right? So for several reasons. One is you're kind of, for the investment to make sense, you need to go like this. You go like this is even harder, right? So I think that is, and time works against you. Number two, like it takes up so much time to right size a company, like right ship a company, than otherwise. So it's a time that you're not getting new investments in the thing. And number three, like it's a huge like reputational issue, right? Like, why did you guys not figure that out before you did the deal? Or like, are you a bad manager and all these things? So there's obviously like, it is not a good outcome, right? We understand that. But it is inevitable. COVID was like the biggest like disruptor for a lot of these industries. Look, the first thing you can do, and this is going to sound obvious, it is better to walk away from a good deal than to do a bad deal, right? So having discipline, or even doing a good deal at the bad price. So, or whatever the case is, or with less protections, or with less optimal founding, or whatever it is. So when you're in the throes of a deal, and the next slides, I'm going to go through like an actual deal, and we're going to go through like all the things you'll be working on from end to end. It's really easy to get carried away and be like, oh, I love the company. I'm going to pay whatever price that we need for it. Markets are great. What could happen? It's really important to be disciplined at the outset, right? So that's the first thing I'd say. Second thing I'd say is honestly, once you're in that space, it's just, you got to get to the next day. So like, there's going to be 50 problems. You're not going to solve all 50 day one. So you got to solve one by one. What are the biggest items? The biggest items often in that case is people leaving, right? So you don't want people to leave. So you got to sort of put structures in place that help people sort of retain their talent, or give them bonuses for sort of certain targets and stuff. And you got to make sure you establish stability before you can establish growth, right? So that's important to kind of come back. If there's things really out of your control, you got to really think about, adding more capital or doing other things. And that's always hard and really, really tricky. It's not ideal. I mean, a lot of our competitors, our clients, and whatever have been through that in the last 2 years. And it's not easy. And look, some of it's just out of your control. You just need a little more patience. So whereas you could have exited a company and 2021, 22 or 23, you'd have to wait till 24 to right size the ship. There's so many things you could be doing, but it is a colossal time suck, right? So it is tricky.
The reason why I asked that question is two things. One, if you've actually been the person who sort of like was handling the investment into that company, you kind of wait for 5 years to know whether you made the right bet or you didn't make the right bet. And the second is that as an associate or as a VP as a principal, sometimes you can be given a company that someone else had invested in.
Yeah.
And now it's sort of like your
Yeah. That's very common.
So what do you exactly graded on? Like as an associate or as a principal, what do you graded on to make it to the next step? Because the time horizon is pretty big.
Yeah, no, exactly right. So look, there's comp works in a couple different ways, right? So one is you get, and we can have, we'll have a discussion. We have like a little bit of an AMA at the end, so we can go through some of the stuff. But at the principal VP level, you are given carry in a fund. So like depending on the fund does, obviously it's more long dated because the fund needs to liquidate and so on. Your day-to-day sort of, it's more around the dynamics of the team. So a lot of teams, even though they're a large fund, they have like a financial services team and there's sort of 5 or 6 people that work in that. If a fund is doing this right, they're evaluating you on things you can control, right? So what is your approach to each of these 4 things, right? So are you coming in, are you executing this to the best of your capability? Are you kind of generating it? Are you developing relationships and so on? Most of our people do this pretty well. Where they are weak is sort of the investment idea, relationship building, generation. So that concept, right? So for you, I think I try to go above and beyond in that space, right? Does that make sense? And then managing portfolio value creation. Look, if you're inheriting something, if it's a good fund, if it's a good, well-run fund, we're not going to penalize you. We're actually going to probably give you credit for helping us get through that investment at the end of the day, right? So it's sort of first year, it's where you can get involved and where you can add value. As this continues, it's more of like, then slowly they become your investments and how good of you are an investor, right? So you're right, it is a long duration, but we don't wait 5 years to know how well someone's investments are doing. We know pretty much right away in the next year or two, right? Do we do a good investment? There's enough of a vetting going on in the process also, but that's what you're evaluating on. Does that make sense? Cool. Zach.
Quick question on, you mentioned that 70% of your time can be spent in the transaction space. How does that change as you become more senior, and how does that differ if you're at a mega fund versus more of a middle market fund?
Yeah. So with a mega fund, it's probably like at the initial first 6 months, it's probably like 90% of your time is in the transaction space, right? So just because there's so much deal activity going on. At the middle market fund depends, right? If you have a lot of deal activity, they often are like, hey, we need another, hand on deck. It's probably a lot of transaction activity as well. Some funds are like, hey, we raised a bunch of capital. We are looking for areas to invest. So you're working more on that. As you advance though, from your first year to your second year, it's gonna, evolve into more of the idea generation, sourcing, that type of responsibility. Portfolio management, you'll initially start as a board observer of some sort or working with management teams on different things. About a year or two in, you might be sitting on boards or kind of, working through that often of your own deals or other deals that are happening. So a little bit difference on the fund. I think on the growth side, again, I think on the VC growth side, you're looking at sourcing a lot up front also depending on the firm. I'd be really careful about the funds on the VC side you look at because some firms are just, sourcing shops, right? So if that's what you want to do, great. But, you by the time you get real deal experience, it might take a year, right? So try to get a mix of the deals that you're working on. And VC deals are also different, right? You don't have a ton of data, so you're not doing as much, like you're doing a term sheet, right? So it's not that much of a yes, there's things you need to get through, but you don't have a ton of data to analyze per se, right? So it could be a little different. But is that helpful? Okay, amazing. All right, let's go to the LBO side. We'll come back to the buy side M&A process in a second. Let's go to the LBO analysis. We're going to go through at least one advanced LBO and potentially go through one more as well. So now, we've just to recap, we've gone through overview of the industry to an extent. We've gone through recruiting. We've gone through networking. We've gone through the job to a degree. We've gone through behavioral interviews, fit, and case study. So now we're going to go to and a technical case also. But now we're going to go through as if you were getting a longer form LBO or you were sort of on the job per se. But this is the 3-day interview that we were talking about. You may have to build in cases and you may have to build in more functionality, and we're going to go through that here. All right, what is an LBO? We talked a little bit through that, but someone want to summarize what an LBO is based on their understanding? Bugar, is that your name or someone else's tag?
Yeah.
It is your name. All right, go ahead. Yeah.
So you're asking how the bundle is done, or?
Yeah. What are you doing with an LBO? Like, what is the purpose?
purpose is to buy a company with a good price, and then make a better operational improvements, and then sell it for a good price.
Okay. Yep. Okay, great. And then the model, you're basically analyzing how all these different factors contribute to that valuation.
Yes.
Okay. Let me pause here. Any questions on anything we've covered before we jump into the technical side? Anything? Okay, let's go. All right. So what is the role of debt, and why do you want to maximize debt in a transaction? Who can answer that? Why do we want? Yeah, in the back.
Yeah, it's going to juice up our returns to equity.
Yeah.
Taking on more debt, we're going to be able to put less cash in from an equity standpoint, which means that our final return when we sell the company is going to be higher.
Yep.
The other big reason is that we get a tax shield from the interest on the debt.
Yep.
Which further increases the value that we're generating for equity.
Exactly. And just return and opportunity cost of initial capital, right? You don't have to put a lot of equity in it, use that capital to do something else, right? So it's sort of all three reasons. Great answer. And then what are the types of, does all that make sense to people? We'll throw that in a second. What types of target makes capital candidates? This is like a textbook interview case study. In reality, it's like finding a unicorn if you can find even 4 or 5 of these things, right? So in reality, what you're kind of looking for is good market, good cash flow, stability, growth, cutting cost opportunity, management team, and kind of the riskiness of the business model, right? So I think that's generally where you're looking at. You guys already know that because we went through all the case study stuff. How does an LBO transaction work? Sponsor uses a combination of debt and equity to finance a purchase of a deal. So in this case, let's say you're buying it at 10 times EBITDA. This is what we're going to do in the model. It's a private company for a purchase price of X. Who here is from like a LevFin or a kind of lending back? You are, right? Okay, cool. So I'll ask you a question in a second. But what we do is the sponsors, we work with a whole host of investment banks like yourself to understand where and how different capital providers can provide capital for us. So talk to me a little bit about how you would do buy-side transactions.
Yeah, so I was working in private credit. So we were doing the debt financing for different leveraged buyouts. So there's a couple of different types of facilities we could provide. We could do senior debt financing. So we would have some kind of security position, but you get a little bit of a lower interest rate relative to mezzanine debt. Would be maybe in a last out position, or we would do a lot of unit tranches as well, just retirement. But sponsors would come to us and we would take a look at the profile of the business, margins, predictability, the cash flows, et cetera, to determine just how much leverage we could realistically put on the business to help them maximize their returns.
Great. So great points here. And some of this might be Greek to some people. So we'll go into this a little bit more in the next page, but exactly right. When you are, you as an equity investor care a lot about the upside of the business. The debt investors who are providing you debt really care about the downside of the business, right? Because they're getting a set of returns like 8%, 10%, 12%, 15%, but it's sort of capped, right? Unless you have sort of, really sort of warrants and stuff. But I think if you're capped, you're really doing a lot of analysis on what could go wrong, right? So you got to put yourself a little bit in the shoes of that person and have to walk them through, hey, this is our analysis of the deal. You do your own analysis, but this is what we see as our main risk in the transaction. And frankly, they've also haven't spent as much diligence as you have on the deal. So they don't really know all of the things that are going on. So a lot of times it's a back and forth. And your name was? Katie. Katie will come to me and say, hey, we can't get to 6 times because we think like the customer concentration is too much or whatever. And we'll say, hey, Katie, I hear you, but we did a lot of work. Here's their customer breakdown. Take a look at that, huh?
Better data.
Exactly. So, or we bring Katie into the deal and say, hey, Katie, here's an NDA, sign it, and then we'll get you this information, and then you can make an assessment of what you think, right? So it's a little bit of a push-pull dynamic in a deal context. And then so we ask Katie, and maybe we shop it around with, Aaron's firm and say, hey, all right, where can you guys come to do this? And then we sort of say, all right, can we work together? Give us the most favorable terms, right? We'll usually come to, amount, term, rates, fees, covenants, whatever it is. And then you alluded to this as well, right? There's different tranches of that. Katie's bank, or, you guys can say, I cannot, by rules of my capital committee, get to more than 5 times debt on this company. So then what it means is either say, Katie, can you go help us find hedge funds or something that can cover the rest? Or we'll go find someone else who can give us the other sort of, turn of debt, right? Does that make sense to people on how it works behind the scenes? All right, so let's now go into the LBO here. We're going to get to capital structure in a second. So there's 9 steps to building an LBO. We've done a little bit of that in that first model that we did, but this is model number 2 for people following us. So I'm going to go through the steps, and then we're going to go through the model in the Excel, right? So this is the model number 2 that you have in your files. All right. So building an income statement, you lay out historicals, you calculate the main components of revenue. Usually they'll have like products or services. And the example we're going to use is a, consumer tech business. So it's going to have a product segment and a consumer and a services segment. COGS, OPEX, et cetera. So you're just going to lay out the historical similar to what we did earlier. You're going to calculate historical growth trends. And then once you have, and then you're going to figure out a credible set of assumptions. I'm going to go through that in a second. If you're given a SIM, and I'll go through that in a second. And then once you have a credible set of assumptions for the forecast period, you build out the model itself. And there's something called circularity. I think all of our bankers are intimately familiar with this, but there's certain things in the financial model that need to be built in different steps, and they're not ready yet until you do other things in the model, and they're all interrelated. So what is an example of circularity in the income statement? Yeah, exactly. Interest, why is that circular?
Pulling it from, depending on how you build, you pull it from your balance sheet, so you pull that through.
Exactly. So you need to know how much debt you have on the company to know how much interest you're having, right? So we don't know that yet because we haven't done the transaction stuff. So you'll leave that blank for now, and then you build in formulas for everything else. In the real world and in your case studies, I think if you have 3 days, it's totally a fair assumption to have you build either a sponsor case or a downside case, right? I think it's a completely fair thing to ask. What are these different cases? A management case is what the management teams gives you in the SIM or in the sell side investment memo. So who are our bankers here? So Zach, I think you're so generally, these would be favorable numbers, right? So can you give me a little bit of context of how you guys came up with these?
Management numbers is like always the best case scenario. It's always going to be overly rosy. They want to give you, the bankers, the most optimistic scenario. So it looks the best and they can get the best of whatever they're trying to do.
Exactly. So within reason, right? You got because we'll go back to Zach and say, hey, like, how in the world are you guys getting to 10% growth, right? This company is going at 3%, right? So you have to sort of have quantified, but you are positioning the company as a sell side banker in the most sort of favorable way. In reality, in the real world, in a case study, you may have to use a management case and you don't have time to do all the work to do a sponsor case. But in reality, I'm not going to say we ignore it. I think the language is a little too strong here, but we build our own case, right? And largely sort of think that there's a lot of rosiness going on in that case. Then we get to the sponsor base case, which is the case that is the most realistic, right? Based on what you are working on. That's weeks of diligence. In this case, maybe a few days of just work around it. And all the assumptions are vetted and sort of backed up with analysis that you're doing in the real world. And this, when you go to investment committee or when you're doing your sort of pitch, is going to be the most realistic case that we're going to spend time on. Right? Why did you get to this revenue number? What do you have to back it up? Why did we get to this cost number and so on? Does that make sense to people on the first two cases? All right, then we'll go to the upside case. Is represent the best case scenario, right? If you're doing sort of a round one model or some sort of a case study model, you could just take the management case and assume that it's sort of the upside case. Or is there something unique about this investment? Like when you get to a real deal scenario, like let's say you have a portfolio company that does something ancillary in Canada and it's an area you can grow, or Europe, maybe you can drive more synergies, right? And maybe it's a little bit hairier, but you can drive more synergies and that can give you a lot more upside. So I think needing to be realistic a little bit, but also trying to be a little more, upside driven in this case. And then downside case, I like to see you guys build downside cases in case interviews because I want to know that you're kind of thinking through some of the risks and mitigants. So in an interview, if you're given 3 days to do it, just build a management case and a downside case. That's probably enough because you don't have enough data to build a sponsor case or an upside case. You can caveat the management case with the stuff you're doing, but I think a downside case is important because I want to know what my bounds are, right? If truly we're going to a recession and there, 60% customer concentration, if the downside case gives me like a 8% return, then I don't even want to look at the deal, right? Because there's too much downside in that space. So I do think it's important to build a downside case. Does that make sense to people on this piece, on the cases? Any questions? Yeah.
The management case is for the sell-siders, so it's more conservative, or I thought the sponsor-based case was like towards the PE firm itself. So what?
Yeah, let me rephrase. The management case is the case you've been given from the management team or the sell-side bankers. So they say, hey, look at this company. It's this is what it does, and this is what we think is going to project to grow in the next 5 years. So they give you those assumptions. You as a sponsor-based case are saying, hey, do I agree with this? Do I think that makes sense? Or do I think it's too optimistic? And Zach shared with us that sometimes they're pretty optimistic because you're trying to sell the company. And not that they're unreasonable or kind of unrealistic. I I got this question yesterday is like, how much should your base case be off from your management case? I think, there's no right answer. I'd say somewhere in like 15 to 20% is fine. It kind of is reasonable. It's what I've seen us do, but every deal is different, right? So, it's hard to really pinpoint. Good question though. Does that clarify your question? Okay, cool. Number two, you build a balance sheet, right? So you lay out historical financials, historical balance sheet. In order to build projections, there's two ways to build projections on a balance sheet. Number one, you use what's called a ratio method, which means you are using just one assumption driver, right? So things like inventory or accounts payable or accounts receivable, they use usually something called days sales. Again, I'm not going to go and do an accounting class here, but I think you use certain metrics those are one ratios that you can change. There's other things called roll forward or sort of have more multiple inputs where you start with a number and you end period with a number, which is something like debt or CapEx, which you start with beginning CapEx and then you add additional CapEx and you subtract out depreciation, right? So due to circularity, once again, you have to leave cash and debt sort of on its own before the model is fully completed. Then you're building out the cash flow statement. There's three parts of the cash flow statement, right? So you can only really build out the operating cash flow, which still doesn't have interest expense yet, but it still has net income. And then you add back non-cash items. We're going to go through that. And then you build out the investing cash flows, right? So any CapEx or other investments you're doing, you can't build out the financing cash flows yet because you don't have any of the debt sort of, mapped out yet. So you leave that aside. You'll come back to it. The circularity, like I said, is in debt and cash and therefore in interest and other things as well. Okay, so now let's go to the model itself and let's walk through building that piece out for everyone. Let's go to model number 2. Too small. Yeah. Way too small. Better? More? Better? Back? Okay. More?
I think we should just follow on our.
Yeah, that's fine. So I'll do my best here. I didn't want to cut off like a lot of the right rows, but it's no worries. So let us start. So let's start with the detailed sort of LBO model here. Like I said, this company, this is an interview case, kind of the 3-day sort of interview, perhaps. They give you this consumer services company, which has a product business and a services business. So you take the SIM and you map out what's in blue here, which you can use the same model to do it. It doesn't matter, but you map out their income statement, right? It start here and say, all right, this is how their income's been growing in the last X years. This is the growth rate. This is how the services revenue is growing. This is the growth rate. This is how the other revenue is growing. And this is the growth rate. And this is total revenue, right? Then we go to COGS. This is the cost of goods sold. This is the gross profit there. SG&A, other expenses, and EBITDA, right? So we get down to EBITDA. Again, all of these are just historical. So it's not really, anything else. And then you're going to get to depreciation and amortization, which again, historical financials, you're going to get to what's in the historical. There's two pieces here, right? There's one line for historical interest, and there's obviously one for the future, because you're completely changing the cap stack. So your new interest, it doesn't have to be in different lines. We just put in different lines for illustration, but understand that the new interest is it's a whole thing that's going to be separate with this model. Then you get taxes, and then you get net income. Then what you do here is now you need to project out future years, right? So we built out this pretty detailed assumption sheet that's going to go through and lay out all 4 cases. Like if in a case, you only need 2 cases, you can delete those rows, hide those rows, whatever you want. But we have a management case, a sponsor-based case, an upside case, and a downside case, okay? So this is an example of where management case is pretty rosy, right? They're growing at 4.5% in the last 3 years, and management wants us to believe they're going to grow at 6%. Maybe they will grow at 6%, right? But for a sponsor-based case, especially in an interview setting, you could make an argument, like you could take management case, it's okay, or you can make an argument that, hey, I don't know that this is going to happen, so I'm going to go with 4.5%. That's what this row is. Upside case, we took management's case, and downside case, we just took sort of a low point that could happen. Again, in 3 days, you may not be, yeah, was that a question? Okay. You may not have time to go do a lot of downside case diligence. And what we do here in this model is we have something called, we have these like toggles up front, which are even more kind of detailed. So you have like revenue growth, COGS toggles, OPEX, and CAPEX toggle. And so, and by the way, I know people had conflicts different on this, so feel free to like, you can reach out afterwards. I know some people here had other things that they had to go, so it's completely fine. And we're gonna share the recording. I mean, don't leave. If you want, you can leave, but I think don't just assume you're gonna watch the recording or something. But yeah, was it a question?
Yeah, it's a question about the growth rate. So
Yeah.
it's a little bit in like public markets where people really fought me on my growth rate assumptions. I know it's a 3-day thing. Like, is the point just to show like, hey, given these assumptions, let's go for is it reasonableness? Or are they gonna say, really walk me through why is that 4.5, 4.5?
I'm not gonna ask you why is it 4.5 versus 5 or something. I'm gonna say, what do you think is supportive of that growth rate, right? So what is your understanding of the business or the industry that supports you believing it's 5%? You say, hey, look, they've been growing at this in the last few years, sort of, they're doing those things pretty well, and we think the overall industry is going to go at 5%, so we just put that number. Or, hey, they've consistently increased market share over time, and they've kind of, they only own 40% of the market, so there's going to be an outsized growth. So that's why I'm comfortable going from 4 to 8%, right, or something. So there's some rationale behind it, but I'm not going to fight you on 4 versus 5, right? It's not worth it, right? So I think then you have these toggles. Again, these are more mechanical stuff. The way I'm gonna approach this model is more as much what we do in the real world or the case as much as mechanics behind building an Excel model, right? So we're gonna try to do both at the same time. You can build these different toggles in for like revenue, COGS, etc. What that does is for you is to save time. If you have 3 or 4 lines of revenue, rather than going and have to change cases in every single revenue or whatever, you could just pull one toggle in and do it. Or if they say, hey, we think the services business is going to grow faster than the other side, you can sort of use that toggle for one and the other. Again, it's just giving you guys more functionality. You absolutely don't need to build toggles in a case study interview. It's not really something that you need. You have this line here, which is the input line. So just make sure whatever case you're on, you can use an index function to just grab that particular assumption, right? So if you want to go from base case to downside case, you just need to change sort of here for, and then you could go into the assumptions and it chooses like the downside case. It's just a way to sort of to like do things quicker. And then we have COGS, and COGS we do it as a percentage of revenue in this model or in this company. Again, here management has just taken sort of the last year's number, which is 38.5. I might argue that, hey, yes, COGS have been going down, but they went up from 15 to 16. And so I need more evidence to sort of believe that. So I'm just going to take an average of the last 3 years. Again, it's not a huge deal if you do one or the other. Same exact logic on all of these rows. So SG&A, D&A, other expenses, and so on. Does that make sense for assumptions? Question? Yeah. Okay.
So when you say downside case, this is not like you have a customer that's 10% of your revenue, you lose the customer, what happens? Like this is more so just if you don't achieve the growth rates or if you don't achieve maybe the margin expansion that you're kind of expecting as the sponsor, what would be maybe just a start with
questions. This model does it that way. But I think if you go through the diligence or whatever and understand or think that, hey, there's a real risk here, then you could, I think the way I do for especially the next 2 years is build in a recession number for growth for 2023 and then go back to the normal rate, right? So I just want some sort of logic there. So this assumes like it's a pretty stable business. And so what if there is sort of a longer pace recession or something happens that you don't get to those growth numbers, and that's how this does it. But I think just having a justification for growth rate is probably the most important. You could do it the first way too, but I just don't know that you'll have a lot of information about that in a 3-day period, right? That's the only. Okay, so balance sheet. Actually, let's go to income statement, right? So you're projecting out, right? So this is the only like thing you're doing here that is going to be different is you're taking product revenue and doing 1 plus G. Again, I don't want to go line by line because I do want to sort of have a healthy pace here. But if someone wants me to slow down, I'm happy to slow down further, right? So and then so you do the same thing for all of these other lines, and then you get to COGS, and then you get to SG&A, and then other expenses. Cool. Does that make sense for people on sort of how we're just using a set of assumptions and mechanically building it in and then projecting it out for the next 5 years, right? Does that make sense for everyone? Cool. Any questions? Okay, cool. All right, so we'll do DNA and then we'll leave this interest expense blank for now because we need to come back and sort of do that. Assets, balance sheet. Balance sheet is a little bit different, right? So inventory projections, we use things like days and things for inventory for receivables. And so same thing here in the assumptions. You have a section for balance sheet projections, and you project them out based on historicals. Same exact idea. Okay, so let's go through that piece of the model here. Here, it's a pretty simple formula, right? It's days of inventory times daily COGS is how you sort of build that out. Again, it's the accounting concept. Yeah.
Like in the income statement, you you put the yellow cells, like the input cells, just below the kind of the assumptions.
Yeah.
So it pulls in from the model assumptions tab. But in the balance sheet, your formula has to connect to the model assumptions tab. You know what I'm saying?
I mean, it's all just sort of practice because I think.
There-
Okay. Yeah. I mean, the real reason is when I look at an income statement, I want to see growth rates. Right. So I want to see how each of the segments are growing. Right. So I could just leave it on the balance sheet, but or the assumption sheet, but in practice, I do like to see all of the metrics here. Whereas for a balance sheet, like unless there's huge fluctuations, it's not something that I'm really changing days from this year to the other. Right. Does that make sense? So when I put this out to an investment committee, or frankly, when you guys put this as a case study, I do want to see, it doesn't have to be growth rates by segment, but I do want to see growth rate. I want to see margins, all that stuff, because more than the numbers, I just focus on trends, right? I'll say, why is COGS going from 38 to 36, right? As opposed to why is it going from 500 to 400 or something, right? So it's sort of, so is that helpful? Kind of.
Yeah, because you would just see the fluctuation in the working capital line on the.
Exactly, and it's very, yeah, it doesn't move the needle that much. All right, so same thing, we leave goodwill blank, guys, and then we do PP&E. The way we do PP&E, I mentioned this earlier, we built something called a schedule. So basically you take opening balance of PP&E. What's in PP&E? It's CapEx and then take out depreciation, right? So you come to an ending balance of PP&E, you plug that into your ending balance here, and then you leave goodwill outside for a second, and then you do accounts payable, which again is the same thing, right? You take days and then you multiply times daily COGS, and then you get to that, and then you leave debt. Again, you have to come back to debt because you were adding on a ton of debt from the deal, and then you get to that balance sheet. Income cash flow statement, you start with net income like we have, you add back depreciation. I think you mentioned that in our prior example. And then you take the impact of net working capital. Why is net working capital in the cash flow statement? Yeah, Ravi.
So basically what you're trying to do is offset your account receivable, payable, and accrued expenses, like all the accrual based accounting, and trying to undo it over here in terms of negating anything that did any cash that
Cash impact. Exactly. So let's pick an example. If account receivable is increasing year to year, what is the impact of cash?
that would mean that your assets are increasing and then cash is going down.
Correct, because you're investing in assets with cash that are not sort of, you basically, someone owes you money that has paid you. What if payables?
Payables increasing, that means your liabilities are increasing, your cash is going up.
Correct. So does that concept make sense to everyone? I think a lot of our people get a little turned around by this. Generally, it's called current assets minus current liabilities. So any sort of inventory is actually one of the easiest thing to think about. If inventory is going up, then you're basically investing cash in inventory that hasn't kind of shown up on your income statement yet, right? So it's an outlay in cash that needs to be captured, right? That makes sense to people. So, but what we care about here is not the cash amount per se, like how much inventory there is. It's like the change in cash, right? So we take current assets, subtract our current liabilities, and then figure out how that changed year over year, and that's going to be the impact of cash. So it's the change in net working capital that we care about. Got it? Cool. Okay, so we do that, and then we get to cash flow from operations. Cash flow from investing is a pretty straightforward CapEx tab, and then you leave, like I said, debt and investing, or debt and financing cash flows until you can do that piece of the puzzle. Make sense? Cool. All right, so let's keep going. So step 4, transaction assumptions. Before you build any of the debt waterfalls and anything like that, you need to know how much debt is actually being taken on by the sponsor, which is determined by the dynamics of the deal, obviously. So first we determine the purchase price. So in the prior model, we did this the other way. And then, you go and reach out to these different providers and have them give you capital. There's a bunch of different tranches of debt. A lot of times you can just assume one tranche and sort of make it easy. In this case, we're using a revolver, which is a revolving line of credit, which is almost like a credit card. You draw down when you need it, or you kind of take it up when you can pay it off, or you take it up when you need it. Businesses that are seasonal or businesses that have big debt payments coming due could use a revolver to manage their cash flow. Term loan A, term loan B, again, a lot of times you just use one kind of row for senior debt, but in this case, we're saying, hey, a bank or capital provider can give you X, and then the other provider can give you Y, and that they have a little bit of a different dynamic. One might be a little bit more expensive, the lower rung of the capital structure, and then sub debt, which is sort of more of an unsecured debt that doesn't like have any amortization. It just is debt that you need to pay through the course of time. Again, we might be trying to maximize the amount of debt, right, that we want to get into the deal. So whatever we can do, the better. Sources and uses is the next thing. We did that already. Can someone tell me what are all the different examples of uses of cash? We did one already, which is transaction purchase price. What are the other uses of cash? Anyone I haven't called on? Why don't you go?
Yeah, fees.
Yes, fees to
Transaction
advisors.
financing fees, M&A fees.
Right.
What else? Cash on the balance sheet that you want to keep.
Excess cash, yeah.
Yeah, excess cash. Well, you'll have like in the EV, you'll have some items that you can roll forward, like minorities, etc. Or if you're buying them out, like that's
Yeah, exactly.
expense.
Basically, these are great examples. Fees, paying down of debt. Another one, if you have existing debt on balance sheet, you got to pay that down. Any cash that you kind of, well, I guess excess cash doesn't come up as uses as much as if it's more like if you need to add more cash to get it to a certain balance, that would be sort of thing. And excess cash is about sources, obviously, but I think that's what you meant. So we'll go with that. And then I think fees and stuff. So it's clearly you and Zach and Katie are not expensive. I mean, are not cheap. Bankers are not cheap, right? So we're gonna have to add in those fees as well. Sources of cash are where you're getting cash from, right? Equity, all the points of debt, and also any excess cash on the balance sheet, right? Does that make sense for people? This to me, I love sources and uses. In a case study, you may not do a closing balance sheet and do all the goodwill stuff. I like doing it. Basically, you build a visual tool to get you from pre-close to post-close. So all the things that are happening in that, you can build a closing balance sheet. So first you calculate goodwill. Again, in a case study, or even frankly, you're not going to be, there's other things in goodwill. Have you guys done goodwill yet in accounting? Yeah. Okay. So there's things like fair value adjustments and all that stuff. Case studies, again, there's a pretty wide gap between academic and sort of what we do in these case studies in real world. So try not to get super inundated with your academic stuff. I mean, it's all great, but I think just simplify what you're doing here on this other side. We don't do any like fair value adjustment or anything. You just take sort of excess purchase price. And then you can use you can do the impact of all the other transactions that are happening at close. Let's spend a minute here on leverage. So Katie, can you walk the class a little bit through? I mean, I'll start you up, but can we walk them a little bit through all the different types of credit that are available in a transaction and sort of how a sponsor might use them? Okay. Not to put you on the spot, but I'll fill in anything. I don't think you'll miss anything.
I was going to say, I think this slide does a good job. I think in terms of seniority, it's probably the easiest way to go. So revolver line of credit, like you mentioned earlier, a lot of times this would be used for managing working capital, especially for seasonal businesses. And from there, then you would have your kind of senior debt. A lot of times your senior debt provider is your revolver provider. They'll provide kind of both for you. And a lot of times the pricing is actually a little bit closer in line, but it could be a little bit different. But the senior debt, your term loan A, that's secured debt. So at the end of the day, your lenders have a security on your assets if something goes wrong with the deal, if you break your covenants, et cetera. Usually senior debt, you'll usually have some kind of covenant depending on the size of the deal. So some kind of, maybe it's a leverage covenant. Used to have fixed charge coverage covenants, not so much anymore. Then sub debt is a little bit more expensive. It's more expensive because you don't have that security claim. So when things go wrong with the deal, you're kind of behind the senior lenders in the waterfall. Mezzanine debt is even, well, I guess with sub debt, you could have term loan B debt versus truly unsecured debt. So mezzanine would be lower in the waterfall, higher priced, but still better than putting in additional sponsor equity. So at the end of the day, you kind of want to go from like cheapest, and there's some other trade-offs there in terms of terms. Sometimes maybe you will take a more expensive form of debt if it means you've got more flexible covenants, et cetera. But a lot of times it's a trade-off between just whatever the cost of your capital is going to be versus putting in incremental equity dollars. The last thing you want to do is have to put in equity unless you're looking for a more flexible cap structure.
Great job. I think, you can teach this portion of the class going forward. No, I think great job. Any questions on what she said? So basically, yeah, go ahead.
I don't know what you said, but on the table, how come we can have an LTV from 10 to 60%, but the the debt to EBITDA is 5 to 6?
So, I mean, again, these are rough numbers. These aren't like saying, I mean, we use sort of, typically it says 10 to 60 just because it should probably say 50 to 60%, but it's sort of rough numbers in that you're not going to do a deal that has 10% of blending in it, right? So it's sort of, I think we were trying to cover all of our bases here in case you had sort of, you know, a ton of sub debt that you need to go in that case. But in reality, it's like, you're not going to do this deal if it's not more than like 40% of that, right? So good question. And then pricing is somewhat important as well, right? So, you know, you're going to take into consideration the dynamics between how much more that incremental value of kind of financing is versus your own cost of capital. Clearly, Katie's example is a good example. Like every incremental dollar of debt you can get, as long as the business can sustain it, is greater than the cost of capital, or less than the cost of capital of your 25% that you need to get the return on. But oftentimes it's a kind of liquidity question, and sort of, are you able to service those things? And what if something goes wrong? So as a practitioner, you never want to go like beyond what is even sort of in your kind of middle downside case, what you think you can get, because guess when it's the most expensive and the hardest to refinance your debt is when the market is going down, right? So I think so you never want to be in that position. So we always try to manage, even as growth investors, we try to manage for 20% downside, even in that case. So if we get to 6 times, maybe we'll go to 5.5 just to be sort of on the safe side. Cool. All right. I think that's just an important sort of detour that we needed to take to get an understanding of what's going on in the model. Escape. No, my like, yeah, no, my like, I keep clicking through it, but my escape button is not working. Like in the screen share. I was gonna go to the model and walk you guys through. Let me just get through the end of the deck. Stop sharing. Let's share again. All right. So let's go through now the transaction assumptions. So what are we doing the deal at? So we talked about this. Entry price 10 times EBITDA. We take 318 million of EBITDA, and we're doing this deal at 3.18 billion. And then what are the financing sources? Again, these are all assumptions. You'll probably be given this in a case study, or you'll have to make some of these kind of up on your own. Revolving line of credit, you're drawing down some of that. One, the majority of this is coming from the term loan. So about 4.5 times, right? To your point, how much can you get in the debt? You might be able to finance another half a turn through sub debt. Again, if your assumption in a case study comes out to, you know, if it's 10 times deal to somewhere between 4.5 to 6 times leverage, you're probably in the right, you know, like zip code. And then obviously you want to take into account interest rates and fees of these things, and you want to take into account amortization, right? How long, like how do these, how much percentage of the principal is due every year? Then we get to sources and uses. Like I said, uses, purchase price, financing fees are just the fees of doing this transaction. There's a little more advanced functionality that's going to be in a third model, which is going to have like revolver commitment fees or undrawn fees and things like that. We don't have that in this particular case, but you can see that in the next case. You're refinancing the target debt of 150 million. You're paying 25 million to our wonderful advisors here, and then you have other fees. Again, if it's a real deal, this might be more like 25, 30 million, because you're doing a lot of legal, you're hiring lawyers, right? You're doing all this work, but you know, again, it's just an assumption. Okay, sources of cash. There's excess cash on balance sheet. We use that revolving debt, term loan, and all this stuff, and then the remainder. So what we do is we equate sources to uses, and then you everything else is filled by your sponsor equity. Does that make sense for folks? Yeah.
Just one question. Considering that you're going to be getting some, like the 220, you're going to get some of the carry. So when you're looking at uses, do you include the fees that you will get?
So you're doing this,
or you don't?
yeah, I mean, so you're getting sort of, that's on the, it's a good, let me get to that on the next model. Okay, so like the initial stages, you want to just do it based on the company as a whole. Like, what does the investment do on its own? So we do incorporate like returns and all that stuff later, but for now, we'll stick to sort of the company, how it does. Closing balance sheet, guys. Again, I'll keep the pace up here. Purchase price allocation, right? We have the excess book value, excess purchase price to book value. You take that as goodwill. You're refining the target debt. So basically what it does is I want you to get to from starting number to ending number, and then you're adding a bunch of new equity and debt, and then you have a bunch of fees you're going through, and that gets you to the closing balance sheet, right? That's pretty obvious. Okay, so now let's get to the debt waterfall, which is kind of the more interesting part of the LBO model. The way you set this up, again, I'll go back to the Excel here and share it. We are pretty close to the we're gonna go through. I mean, we're like maybe 20 more minutes in the model, and then we're gonna open it back up to sort of any personal questions and stuff like that, right? So debt waterfall. Can someone walk me through the mechanics of a debt waterfall and how they would set it up? And what are we trying to do? Do you want to walk us through it?
Oh, sorry, sure.
What's your name? Samir, thank you.
Yeah, I guess I would set it up as like you have a beginning balance in each period, and then you have a certain amount you have to pay back, which is mandatory.
Yep.
Then there's your which is mandatory as part of the principal payment.
Yep.
And you get to your ending balance, and then if you have any excess cash, you would also factor that in at that point to pay down it.
Exactly. Great point. I think the interest expense you would capture in the cash flow already in the interest line, and then what we're trying to solve for here is how much cash is being generated by the business before we get to financing, and then how much of that is being used to fund the minimum payments, right? Think about let's say you have student loans or something, right? So and you have a certain amount of cash flow during the year. You're going to pay interest on the student loans, and then you're going to pay the mandatory principal on the student loans. If you have any cash beyond that, like let's say you had a huge bonus that year, you're going to pay down the rest of the debt, right? So that's kind of how I think about it. If there's excess cash after you pay down your mandatory payments and after holding a minimum amount of accounts on balance sheet, because most companies can't operate with zero cash. So you can't just strip the cash out every year and pay down your debt. Beyond those two things, you can use that to pay down additional debt to get your debt balances down. You know, we can have a theoretical discussion of do you want to prepay debt or not, and it all sort of depends on opportunity cost of capital and how much expensive that debt is and all that stuff. But on a surface level and in a case LBO, let's assume you're going to prepay that debt with excess cash, and then such that at the end of the term, more of the equity accrues to you. It's like if you have a mortgage, right? If you keep paying down principal, ideally by the end of 15 years or 20 years, you've paid down X amount of debt and you're left with sort of the upside in equity, right? So that's how I think about it. It's kind of very comparable to that. And then, so the logic here is excess cash generated by business is utilized as follows. Number one, first, mandatory principal payments on each tranche of debt. Next, minimum cash needed on the balance sheet stays on the balance sheet, right? So any minimum cash that you need. Then if there's any excess cash, you pay down, prepay the debt, or you do discretionary pay downs. What if there's a shortfall? Yeah.
You probably use your revolver to borrow a bit.
Right. Yeah. So that's why you have sort of a line of credit. You know, I think you want to manage that. When you build a model out, you want to sort of manage that, but there's not big chunky things that are happening. But that's kind of how the logic works. Again, as long as you understand the mechanics, building it in the model is not that complicated, right? So we'll just quickly show you in the model in a second. Then putting all the financial statements together, right? Once the debt waterfall is built, we know how much total debt is paid down, and thus we know how much the debt balance is at the end of the year, right? Now we need to start linking everything back. So now we link the debt pay down amount back to the cash flow statement, right? To sort of the financing cash flow. So now we've completed the cash flow, right? So we have the financing items, we've completed it. You get to ending cash, and then you link the debt and the cash back to the balance sheet. What's left is your interest expense, right? So that's the final piece of the puzzle here. Now you have the debt balances for the whole everything, and you just need to calculate interest on those and link it back to the income statement. Does that make sense conceptually for people? Okay, cool. So let us go back to the Excel and walk through this next two steps, and then we only have one step left. Okay, debt waterfall. How I like to do it and how I sort of have our people do it is just set up sort of mandatory principal payments that you have for each of these things. So you know 10% of these amortize off every year. So you need to absolutely pay 143 million of debt every year. So that's a mandatory payment that you need. So then you calculate your cash flow before debt payment. So this is your operating cash flow and your investing cash flow. you get to 119 million. 143 million of that is mandatory. So guess what? You have a $24 million shortfall. That's one piece, right? Does that make sense? That's a mandatory payment that you have. And then the beginning cash in that period is 200 million. So we established that up front. You lose 24